You know, you hear a lot about bubbles in the financial world, and let's face it, when bubbles burst, it's never a good thing. And we saw this when the dot-com bubble burst, when the housing bubble burst in years past. But what about bond bubbles? Are we in one right now? And what's at stake for everyday investors if it bursts? It's time once again to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional style investing to your portfolio. For quite a few years now, some market pundits have been discussing or even outright predicating the bursting of a so-called bond bubble. Their logic's quite simple. With long-term interest rates having been manipulated downward by the Federal Reserve in response to the financial crisis, that at some point those rates must rise again. And since, as most people know, when interest rates go up, bond values go down, a sharp rise in rates will inevitably mean a sharp drop in bond values, which is what they call the bursting of the supposed bond bubble. But you know, that simple logic ignores or even overlooks a lot of important details which we'll be examining right here on today's show. And joining me with their insights and expertise are author Graham Summers and advisor Scott McLean. First, though, let's take a closer look at this question of whether or not we're actually in a bond bubble and whether there really is such a thing in the first place. Back in February, when the stock market experienced a full 10% correction, most analysts blamed Wall Street's fear of rising interest rates and inflation for the massive sell-off. That fear began to build in January when the stock market was hitting new record highs. At the same time, the bond market seemed to come out of a coma and all of a sudden recognize that with the unwinding of quantitative easing underway, the yield on the 10-year Treasury should be higher. As a result, the 10-year Treasury rate spiked from 2.4 in late December to 2.8% on February 2nd, causing bond values to drop and creating somewhat of a headwind for fixed income investors. Now, even though it was a slight headwind and the situation was really nothing unique or surprising, many pundits at that time began warning once again that we might be seeing the bursting of a so-called bond bubble. Now, I say once again because some market watchers have been sounding that false alarm for several years now. They've been sounding it again recently. Why? Because, as we discussed on last week's show, some believe conditions are once again right for inflation and therefore rising interest rates. And those two things, of course, are closely related. Well, if you have been watching the show for a while, you also know that I have never been one to have jumped on this bond bubble bandwagon. Say that fast 5 times. In fact, I've argued that many of the experts who keep trying to generate fear over a bursting bond bubble are likely doing it for one of 2 reasons. One reason is that they might just be uninformed as some of the important details about how the bond market really works. Or 2, they have a vested interest in trying to sway everyday investors away from bonds and into other investment options, namely common stocks and stock mutual funds. So let's take a minute and go over some of the important details to which I'm referring. Details that to me suggest that there's not only a bond bubble that's in danger of bursting, but that the very term is misleading and technically inaccurate. The first detail has to do with the Federal Reserve, which has raised short-term interest rates twice so far this year and has vowed to approve as many as 2 more rate hikes before the end of the year. Now, as I mentioned on last week's show, 2 factors the Fed is watching closely as they move forward are the inflation rate as well as long-term interest rates. To a certain extent, the Fed needs both things to keep gradually rising in order to make those additional short-term rate hikes possible, or at least to decrease the possibility of their stalling economic growth or panicking Wall Street along the way. I also mentioned last week that many economists believe the effects of the Trump administration's tax cuts, which actually paved the way for a 4.2% GDP growth in the second quarter, that those effects might just be short-lived. Even the Federal Reserve had forecast growth shrinking back below 2% by the year 2020. Now, if that's true and consumer demand shrinks again, then prices simply can't rise. In other words, inflation stalls. At the same time, several factors are in place that I believe will continue causing long-term interest rates to hit a strong resistance level right at that 3.25% range or so that we've talked about on previous shows. In fact, so far this year, that forecast has proven accurate. And we'll talk more later about why long-term interest rates should continue hitting this glass ceiling. But even if they did go higher than that 3 or 3.25% rate that we're discussing, and the Fed hits both the inflation and interest rate benchmarks it needs in order to confidently move forward with more short-term rate hikes, even in that case, this idea of a bursting bond bubble, I believe, is extremely misleading. In fact, I think it's often nothing more than a scare tactic used by certain analysts and advisors whom, as I said, have a vested interest in steering investors away from individual bonds. In reality, the bond market's reaction to the prospect of the Fed rate hikes is typically gradual. Bonds may suffer modest price pressure over an extended period of time, but hardly ever a sudden crash or explosive burst. The closest thing to a recent crash occurred in 1994, when the Federal Reserve mismanaged their policy, I believe, by raising rates too quickly. But even then, the loss in values on investment-grade bonds was still slightly less than 3%. Now compare a 3% loss to a 50 or 60% loss that some investors suffered when the stock market plunged in the beginning of the year 2000 with the tech bubble having burst, and again in 2007 with the financial crisis. In fact, a look back at the entire history of investment-grade bonds shows that the downside in treasuries and investment-grade bonds has always been relatively limited. According to data compiled by NYU Stern School of Business, the 30-year bond has suffered negative returns in only 15 calendar years since 1928. And even in those cases, the losses were extremely limited. While past performance is not an indicator of future results, it does help illustrate the rarity of a major collapse in the bond market. Or, as I like to say, all the financial markets zig and zag, but the bond market typically doesn't zig or zag nearly as dramatically or as dangerously as the stock market does. We'll talk a lot more about that and why that's so in just a bit. But right now it's time to welcome our first guest, Graham Summers. Graham Summers is President and Chief Marketing Strategist of Phoenix Capital Research, a global investment strategy firm right in Washington, D.C. His cutting-edge business and research insights have been featured in media outlets around the world, including NBC, CNN Money, Fox Business, and Rolling Stone magazine. He's also the author of best-selling book, The Everything Bubble, The Endgame for Central Bank Policy. So Graham, tell us, what prompted you to write The Everything Bubble?
Oh, sure. So the concern I had was that in the aftermath of the 2008 crisis, central banks took extraordinary monetary measures to try and sort of sustain the system. Now, in the actual depth of the crisis, I thought that was obviously just fine. You're trying to support what looked to be a really deflationary collapse. But the concern I had was that once you got past about 2011, 2012, what should have been considered emergency monetary measures actually became normalized. So what you saw was central banks maintaining policies that usually you'd only use during a crisis and just sustaining them well into what you would be considered a recovery. And in particular, once you started shifting into seeing central banks implementing negative interest rate policy or even open-end quantitative programs or quantitative easing programs, meaning programs where they're buying assets from banks and it's just open-ended, there's no deadline in mind. I became increasingly concerned that what was really happening was that central banks were attempting to corner the sovereign bond market and in that way kind of create a false risk profile for the financial system. And it's my view that that's essentially what they did, and it continued onward. We still have NERP and QE and multiple central banks going right now. And so that became the concern because, as you well know, the sovereign bond market is the effective backbone of the financial system. No currency is currently backed by gold or by any finite assets. So it's actually sovereign bonds are considered the senior most asset in the financial system.
But what do you think caused it though? How did we get here? I mean, is it because they tried to push people up the risk curve, as many have said, to create more of an asset bubble so people feel wealthy and maybe they go out and spend more money? I mean, what's the motivation?
I think it's a number of things, honestly, and that's sort of the trillion-dollar question. I mean, on the one hand, you've got hubris and you've also got some career risk, which is, ever since Volcker, nobody at the Fed has ever really wanted to engage in an aggressive tightening campaign because it usually results in that person being canned. So that's one component. The other issue is that there's a chart in the book, but if you look at the total debt securities in the United States financial system and you compare that to the GDP, it really went parabolic starting in the 90s. And the concern, I think, is that really their view is that debt deflation is actually a systemic risk. And so they don't want to take any chances with that spreading into sovereign bonds. Whether it would or would not is very difficult to gauge because since effectively the late 90s, anytime the Federal Reserve has faced any kind of crisis of any sorts, their goal is to just be as loose as possible with monetary policy.
Right.
And so the end result is I think they've been slowly moving up the financial asset food chain, first with tech stocks, then with housing, and now with sovereign bonds. And to answer your question, I think it's just a combination career risk, hubris. I think it's really hoping that there'd be some kind of wealth effect. And then, of course, there's the TINA trade, there is no alternative, which is if bonds and income producing assets are at very low yields, hopefully you're going to force people into riskier assets like stocks and things.
That's pushing the classic pushing people up the risk curve argument, 100%. Yeah. We need to leave it there for this segment, but we'll be back. We'll be back with a lot more in terms of words of wisdom from our new friend Graham Summers. You stay with us. We'll be back in a moment right here on the Income Generation.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model. Call now for your free income kit from the Retirement Income Store, where baby boomers go for income.
So my whole dispute with this notion of bond bubbles isn't based strictly on the fact that the bond market functions and reacts differently from the stock market. There are other factors, and one has to do with how individual bonds themselves work as investment tools compared to stocks and commodities and such. So consider this. An asset bubble requires several things to actually be a bubble. Chief among those is the purchase of an asset at progressively higher and higher prices, with ongoing speculation that tomorrow and perhaps the day after, that asset's value will continue to increase. Investors paid astronomical sums for now defunct .com companies in 1999. Why? Because they thought company valuations would continuously rise in the future. This whole concept is important when discussing the concept of a bubble. Bonds, however, by their nature have maturity dates, a point in the future when a given security will be worth a fixed sum of money. With that in mind, it's mathematically impossible for the value of a bond to be worth progressively more and more moving forward. As a result, it's not really possible for an individual bond, and therefore by extension the bond market, to be in a bubble. So even if you did buy into the whole idea of a bursting bond bubble, it's still a moot point if you plan to hold your individual bonds until maturity. While it's true your returns may experience temporary headwinds, again, temporary headwinds if values drop due to rising interest rates, but that too is a moot point when you remember that total return is actually a product of two things: growth and income combined. If you're investing primarily for income instead of growth, as I believe that many should be after the age of 50 or so, then your bonds will continue to generate income at a fixed interest rate regardless of the fluctuation in values. Plus, again, you actually have a contract which guarantees the return of your principal investment if you hold that contract to maturity. In fact, relatively minor fluctuations in long-term rates, like we've seen and been seeing since February, can actually be good for individual bond investors. Why? Because if their portfolios are actively managed, it gives their account managers the opportunity to upgrade for higher yields. So here's another important detail that analysts and advisors who talk about bond bubbles conveniently overlook, or that maybe in some cases they really just don't understand. And that there are other factors beside rising interest rates that impact bond values. One, for example, we've talked about before right here on the show, is something called a risk premium. You see, when interest rates do increase, it's typically because the economy is doing well, and investors are becoming more and more confident. At such times, they generally require a lower risk premium. In other words, less additional interest to warrant them going from an insured government bond to taking on the risk of corporate bonds. Okay? In other words, a lower risk premium means less additional interest for taking on that risk in times of confidence. What that does in the real world is partially offset the negative effects of bond values in an increasing interest rate environment. We saw this very thing play out not too long ago. As you probably recall, right after the election in November of 2016, the stock market shot up. What you may or may not realize is that long-term interest rates also saw a dramatic spike, with the yield on the 10-year government bond jumping from 1.8% all the way up to 2.6%. And this happened between the election and mid-December, literally a 6-week period. That's even a bigger 1-month jump than we saw in January, and could have potentially spelled at least a 7% drop for fixed income investors at that particular time. But for the most part, it barely created any kind of headwind for fixed income. Why? Because corporate bonds didn't experience the same level of sell-off that government bonds did. So, as a result, risk premiums compressed. Although Treasury yields went up by some 0.8% during that 6-week period, yields on corporate bonds increased a lot less. So again, risk premium is yet another factor that runs counter to the idea that individual bonds as investments and the bond market as a whole can bubble up and burst in the same way that commodities do and the stock market can do from time to time. So then, why is it that so many advisors, pundits, and in many cases the financial media in general like to sound the bond bubble warning whenever they get a chance? Well, many of the pundits may have an axe to grind. Why? Because oftentimes they work for a firm that specializes primarily in stock market-based financial strategies. And the media will simply mimic what the pundits say because those same firms oftentimes are their biggest advertisers, and they want to keep those advertisers happy. As for financial advisors, it could be that they too have a Wall Street-based business model that incorporates bond mutual funds rather than individual bonds. And as I've explained before on the show, those are vastly different investment tools. We'll review the important differences between bonds and bond mutual funds again later in the show. But the bottom line is that some experts who like to talk about bond bubbles often do so simply as a scare tactic. Why? Because they have a vested interest in steering people away from bonds and toward other types of investments. It's also an inherent flaw in the system that I've discussed before here on the show. And it's the way Wall Street has a need to speak optimistically about the stock market as often as possible. And sometimes that means pessimistically about other investment options. And this often spreads throughout much of the financial industry. In other words, oftentimes the supposed unbiased information you're getting from an expert is anything but unbiased. Now it's time to welcome back Graham Summers. You know, I've got a theory, and you could tell me whether or not you think that there's anything to this or not, but I feel as though we've been artificially stimulating the economy now for about 30 years. Car leases came out 30 years ago, where people all of a sudden got this belief, well, heck, if I'm going to have a car payment forever, I might as well get a new car every 2-3 years. Right. The first liar loans came out in the late 80s, mortgages, where if you put 30% down, you could say you made, more money than Donald Trump, and nobody cared. So it seems like this is much of a longer cycle. And now it's just that the central banks are getting involved. Am I on to anything?
Yeah, I think you're correct. I think the real issue here is that once you abandon the gold standard in the 70s, and just to clarify, I'm not a gold bug. The view I have is simply, if your currency isn't tagged to anything, there's really no limit to what the central bank can get involved in. If you combine that with the introduction of credit cards and mortgages and junior debt securities, what you've really got is about a 40-year credit bubble that's been generated, and that's really, I refer to it as a debt bubble. But when I say debt bubble, it's not necessarily just sovereign bonds. It's really just this idea that debt's the answer to any issue facing the economy. And really what it is that since I believe the early 70s, the Fed has been effectively papering over a decline in living standards in the US. And the way they're doing this is just by using credit. If your incomes are not actually keeping up with cost of living, you use a credit card. You start using mortgages. You start using things that 80 years ago no one would have ever imagined was possible.
Yep.
And I think you hit the nail on the head. I think the real issue, though, and the reason central banks are increasingly being involved, is that because the system has so much debt in it at this point, when you combine all these different debt securities, that any whiff of debt deflation becomes a systemic issue. Right. And if you actually So if you look at the debt deflation we have,
Graham, we need to take I'm sorry to interrupt. We need to take a commercial break again in just a moment. When you come back, we're going to ask you a little bit about what the government can do to fix this problem, what we can do. All right, we'll be right back here on The Income Generation. I'm David Scranton.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. At the core of all the misleading hype about bond bubbles is this supposed truth. Bonds are a bad investment in a low interest rate environment because interest rates must inevitably go up. And naturally, there is some truth in that. Why? Because like every other aspect of financial markets, interest rates fluctuate based upon a variety of factors. And when they're so low they can't get much lower, logic dictates there's only one direction in which they can move, and that's up. But once again, that's an extreme oversimplification of a complicated formula. Just like stock prices and other factors, interest rates never move consistently in one direction or the other. They constantly experience minor ups and minor downs within broader directional changes. Those broader changes unfold over longer periods of time, oftentimes decades. A look at the rate on the 10-year government bond for the past 54 years shows long-term rates trending broadly upward from 1962 to 1981, and then broadly downward from 1981 to 2012. Now, a closer look at the chart reveals all those minor ups and downs within the larger pattern. As I mentioned earlier, it is precisely those smaller fluctuations that allow specialists in actively managed income-based portfolios to maximize the value of a diverse portfolio of individual bonds, and to be able to do this even in an environment where interest rates are trending broadly upward. As a matter of fact, that's exactly why a few years ago I launched my registered investment advisory firm called Sound Income Strategies, specializing in actively managed income-based strategies. The fact is, I agree. Generally speaking, the 30-year trend in declining interest rates that ended about 4 or 5 years ago isn't likely to return soon. I agree that interest rates have stopped their overall downward trend for now. But what I also believe is that in the light of all the artificial economic manipulation that central banks around the world have done and engaged in now for about a decade or so, the low interest rate environment we're experiencing now isn't likely to change dramatically anytime soon. The glass ceiling, or resistance level as analysts like to call it, that I've talked about for long-term interest rates, is the result of several influences, all of which have the potential to remain in place for years to come. The first influence is the fact that we continue to be, in the United States, what I like to call the cleanest dirty shirt in the world's economic hamper. In other words, economic crises and quantitative easing efforts in many other countries around the world are several years behind our own, and this results in lower yields for bonds overseas. As a result, foreign investors have favored the relatively higher yields being offered in the United States. I believe that this trend is likely to continue, and that the ongoing demand will drive up bond prices and help keep long-term yields, in other words, interest rates, in check. As long as central banks around the world continue to pursue monetary policy that keeps their interest rates low, this will help create a government that should keep interest rates relatively low here in the U.S. also. The other major force behind interest rate resistance level is, of course, you and me. That is, members of the income generation, those of us over the age of 50, who've made the all-important shift from growth-based investment strategies to one geared toward protection and income. Now, while some of the oldest baby boomers are already retired, the youngest are still, in many cases, a decade or so away. As more and more of them make that shift over the next 10 years, the demand for individual bonds and bond-like instruments is likely to remain quite high. Now, combine that with the ongoing demand among foreign investors, and the forces working to keep bond values high and interest rates relatively low are, I believe, quite strong. Strong enough to maintain that resistance level at just or below 3% or so, 3.25%, for some time to come. Now, there are other forces as well, such as the ongoing potential for a flight to quality as big investors rush to the relative safety of the bond market every time the stock market experiences a major sell-off. We saw a bit of that with the 10% correction in February, and we'll likely see a lot more of it when the stock market at some point experiences its next major correction, a correction which, I believe has to be somewhere in the range of 40 to 70%. So I guess the main point is really this. Even if the most basic occurrence necessary for the so-called bursting of a bond bubble, and that is a sharp rise in interest rates, isn't likely to occur, then how can the so-called bond bubble burst? You should also keep in mind that the phenomenon of perpetually low interest rates is not at all unprecedented. It does happen. Consider Japan, which has been locked into a low interest rate, low inflation economic cycle now for over 25 years. Now, while that doesn't necessarily have to be our fate, many economists beside me have expressed the opinion that for a variety of reasons, low interest rates are indeed the new normal. Now it's time once again to welcome back Graham Summers. And Graham, I've got two questions for you that our viewers need burning answers to. Okay. One is, your book came out a year ago. What's happened, if anything, in the last year to make the trajectory any better or any worse?
That's an excellent question. Really, the issue we're dealing with is, can they normalize the situation we're in? And we're seeing that the central banks are trying to do that. You've got the Federal Reserve now engaging in quantitative tightening. You've got them hiking rates. The European central banks announced they'll be ending their own QE program.
Which it sounds like you're in favor of, correct?
It's hard to tell. I mean, really, the big question is, can they normalize what they've done?
Sure.
Because this has never happened in history before. You've never had actual nominal negative rates in some places. You've never had a global coordinated campaign by every central bank in the world to try and corner their sovereign bonds. So the question is, can they normalize it or not? So far, it looks like the Federal Reserve has been successful at doing this. They've managed to drain about $250 billion off their balance sheet. They've managed to hike rates up to 2%. But really, the question is going to be, how far can they go before something breaks? And that's the question no one really knows. You know, we're in really unprecedented waters at this point. The good news is for income investors is that if you're looking to be involved in the bond market, if something starts to break, bonds are the things that they're going to be defending the most. So you're probably going to be seeing a lot of central banking policy if we enter another crisis that would be supportive of bond prices.
So can we fix it, though? In the 45 seconds or so we have left, you know, we're trying to raise rates, but
Right.
a lot of the rest of the world is still easing. So
yeah, and I
we go
think
against
part
the
of
tide?
that's, I think a little bit of that's intentional. I think that's the Fed's trying to be supportive of the dollar by making capital flow to the United States. You see that in the stock market too. The U.S. is one of the few markets that's actually held up. Most emerging markets and even the developed markets in Europe are down significantly this year. Really, the question is going to be, can they get to a state where the economic growth is significant enough that the U.S. isn't running such massive deficits and the debt starts getting paid off? That's very difficult to say. We're running very large deficits now, and that's during GDP growth of 3-4%. So very hard to say. It's very clear the Trump administration is just trying to do a sort of growth approach to this. But really, at the end of the day, the question is going to be, at what point do the bond markets revolt? And it's very hard to tell. I mean, we're dealing with such a senior asset class that trying to time that's going to be very difficult.
But it sounds like you're not concerned about a bond bubble per se, more of a debt bubble as I am. So real quick, where can everybody get your book, The Everything Bubble?
Well, it's currently on Amazon. You can get it both in a paperback, and actually Kindle's running a very significant sale right now on it. And just type in The Everything Bubble to Amazon and it'll pop up, and I'd be delighted if you picked up a copy and left us a review.
Graham Summers, thank you very much. We'll be right back.
My pleasure. Thank you, Dave.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model. Call now for your free income kit from the Retirement Income Store, where baby boomers go for income.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. So why is it then that some financial advisors seem to want to steer investors away from individual bonds and toward things such as bond mutual funds? And many times do that with scary and misleading stories about such a thing as a bursting bond bubble. One reason is that since many of today's advisors got started in the 80s or 90s, during the best stock market in U.S. history, the majority of them, those advisors, have become stock market specialists. If they offer income-based strategies at all, it's usually just an afterthought. And rather than take the time to learn how to strategically manage a portfolio of individual bonds, most will simply take the easy way out. And the easy way is to instead invest their clients' money for the small portion that's going to be in fixed income in bond mutual funds instead of individual bonds. Now, as I noted earlier and have explained before on the show, there's lots of important differences between individual bonds and bond funds, differences that every investor over the age of 50 should know. The fact is, bond mutual funds carry risks, costs, and tax liabilities that can be reduced or even eliminated with a diversified portfolio of individual bonds, or bond-like instruments. That's mainly because individual bonds typically come with two important guarantees that don't exist with bond funds. I alluded to these two guarantees earlier when discussing how total return is really a sum of both growth and income. The first guarantee is a fixed rate of interest for the life of the bond, while the second is the return of your principal investment when the bond matures. And of course, this all assumes that there's no default. What those guarantees provide are basically two things: reliable income to meet your retirement goals, which most investors over the age of 50 say is their number one priority. And number two, protection against zigs and zags in the bond market, and even those that some pundits and advisors might try to characterize as a, quote, bursting of the bond bubble. Why? Because at the end of the day, any loss with an individual bond is truly only a paper loss. That's because it's a strategy based upon investing by contract. And that contract means that regardless of any temporary fluctuations in the market, you're still going to receive your fixed interest payment. And when the bond matures, you're still going to get back your principal. No such contract exists in what I like to call a murky pool of bond mutual funds. Yes, they're still more conservative than stock funds, but they don't have the same contractual guarantees that come with individual bonds. That's because when you invest in bond mutual funds, you're not investing by contract. Instead, what you're doing is you're literally investing in the stock of a company that owns bonds. Another good way to understand the difference between bonds and bond funds is to think of two different scenarios for investing in rental property. In the case of bond mutual funds, it's kind of like investing in a property but having no contractual guarantees, no lease. That means that the property itself may be worth more or less by the time you sell it, depending upon fluctuations in the housing market, but it also means that your tenant can pay you more or less each month. It can vary depending upon what they want to pay you. With individual bonds, however, you have a contract that not only guarantees that, in this analogy, your tenant will pay you a fixed amount of rent every single month, but also stipulates that the tenant agrees to purchase the house from you at a fixed price on a certain date in the future. Now you've got basically the best of both worlds, and that's what you can get with properly managed individual bonds. Bubble or no bubble? Now it's time to welcome our second guest, Scott McLean. Scott McLean is the founder and president of McLean Tax Advisory Group in Waretown, New Jersey. He's a specialist in conservative income-based strategies and has been helping retirees and near retirees meet their financial goals since 1983. He also runs a nonprofit agency specializing in veterans benefits. But most importantly, he's one of my closest friends. Scotty, welcome back to the show.
Hey, Dave. Good to see you, man.
You know, let's start with the basics. What initially drew you to become a specialist in income-based strategies?
Wow, Dave, that's three easy words for me. People need reliability, consistency, and predictability. And that's what I want to offer our clients as I work with them on a day-to-day basis.
Whereas most of the rest of the world is out there offering growth and growth-like instruments, you're saying, no, let's take the bird in the hand. Let's take the income. Do you feel like, you know, in your area, geographical area, do you feel like you're a fish out of water? Everybody else is preaching the stock market and you're talking kind of common sense reliability?
Yes, I feel like I'm flapping around sometimes because people aren't unaware, of the income model, and they're totally unaware of it, and they want to roll the dice.
Yeah.
Roll the dice and hope for the best. And I think, as you said, the bird in the hand is so much wonderful. And when they see the consistency and the reliability, it's
and of course, their advisors are pushing them with both feet to take the gamble too. So Scotty will be right back. Stay with us. We'll be back here on The Income Generation. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Welcome back. We're here with Scott McLean, my great friend, and also a great friend here of The Income generation. So one of your clients' concerns, I know, is reliability. They want reliability and consistency for income. But what other concerns do they voice to you recently?
I'm hearing a lot. Should they jump in the market? Do they have enough money for retirement? I'm hearing a lot of concerns because the market has been like a Dunkin' yo-yo, up and down lately, and the market's been kind of jittery, like has happened before in the previous times, and they're concerned.
What do you think about the stock market, what it's been doing recently, where it's likely to go in the next couple of years?
Dave, I'd love to have a crystal ball, but my crystal ball says we could have some some push to the market. We don't know what's going on. We're in a world of confusion and chaos, and I've never seen it like this before, and I don't want to risk our clients' money. We could have a little bit of push ahead, but like I said, for our clients and people I work with near or in retirement, we want consistency. We want that 6 to 7 to 8% returns. I'll even settle with 4 to 8% on a consistent basis.
Sure.
So it could push ahead, Dave, but I don't want to risk my people. I don't want them waving me at Walmart with one finger. I want a hug.
So what do you find when you talk to people, which you do every day of your life, of course, about this particular topic? What are some of the most common misconceptions that you find exist in the minds of people 50 and over about bonds and bond-like instruments?
Dave, I noticed that Mellon did a study, and 40% of people really don't understand about bonds. And when bonds, of course, the prices fall when interest rates go up. So what does that mean? Heck, I put a little chart together. I don't know if you can see my little chart here. But I think about the chart, and I think about, people getting 4%, they're getting $400 on $10,000. Yet their friend just bought a brand new bond, and they're getting $600 on a 6% bond. Well, who the heck is going to buy that 4% bond anymore?
Right.
In other words, the value will drop. People are totally unaware of that inverse relationship, and they could be totally just destroyed. And so the concern of that, to me and to our people, is how do I get that nice, consistent return? And can I, of course, if I'm in bond, like you said earlier in the show, bond mutual funds, I could really have a disaster waiting for me.
Yeah, that's true. And we talked about that a lot in the show, like you said. So in the 30 seconds or so we have left, tell our viewers, what's the best advice that you, Scott McLean, could tell them if they're part of the income generation?
Right now, as I said, in the world of chaos and confusion and uncertainty, people need honest bottom line answers. Dave, I think about your book, and if people aren't getting it or reading it, I think they're missing out. They need financial advisors that are actually surgeons that can really understand this market and really provide that safe, sound income. So when they go to bed at night, they can sleep well. And I think the biggest concern is people are not sleeping well right now because of all the chaos.
Scott, you really are a good friend with the shameless pitch for my book. Scotty, thank you for joining us. And we'll be right back here on The Income Generation. I'd like to thank both of our guests for joining us for another episode of The Income Generation. I'd also like to thank you, our new and returning viewers. Sometimes certain terms and phrases are branded about in such a way that we end up responding to them on a purely emotional level. We don't stop to think about the logic or rationale behind them, or the potential lack of logic or rationale. I'd argue that the term bond bubble is one of those such terms. Yeah, it's catchy. Sure, it gets your attention and might even scare you. But it's important to understand that a lot of so-called experts like to use it precisely because they hope it does just that, scares you. They're hoping it influences your financial decisions in a way that suits them. But if you can get past the emotional response and examine the actual details, you realize that there's not much logic or rationale behind this scary term. Based upon history, the intricacies of economics, and simple math, it's pretty clear that bonds simply are not an asset class prone to bubbling up and bursting in the same way that other assets can. Stocks, yes. Real estate, yes. Even Beanie Babies, yes. But individual bonds simply work differently, and the bond market functions differently. Even if bond bubbles did exist, and they did burst due to rising interest rates, I believe the evidence today points toward a somewhat stable, lower long-term interest rate environment for some time to come. And as more and more Americans in their 50s and 60s come to understand this, more and more will continue making that important shift from focusing on growth-based strategies, which do in fact often bubble up and burst, to income-based strategies, which are designed to reduce the risk of a major loss and to provide reliable income. Please remember also that since the turn of the century, income-based investors have achieved an average return similar to, if not slightly better than, that of buy and hold stock market investors, who've averaged roughly 5% or so total return with dividends factored in, accounting for inflation. By comparison, many income-based investors whose portfolios have been properly managed have achieved just about the same return in the form of income, and greater than that when you factor in total return. And they've done it without having to suffer through two major losses and recoveries prompted by the bursting of the dot-com bubble and again by the housing crisis. As a result, remember this important piece of advice. Please don't try this at home. Seek the help of a qualified financial advisor that specializes in income-generating strategies such as individual bonds and bond-like instruments, and specializes even more importantly in working with clients near or at retirement age. Thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's absolutely essential that you stay informed and up to date. And right here is where you can do it on the Income Generation. I'm David Scranton. Thanks again, and we'll see you next week.